Welcome back. Well, today we're going to take a look at the average home prices that are published on Zillow.com, by far the most popular real estate website. We're going to compare those actually to the numbers that are released by the US Census Bureau. It's very interesting to see some of the divergences between the two. Now, here we see this is on a month over month basis. This is the monthly change of the average home price in each state. The left-hand side, all the way to the left-hand side, that's the U.S. average. That's the average overall. Then we have in alphabetical order, Alaska, Arizona, Arkansas, etc. Some of the strongest month-over-month changes occurred, for example, in Connecticut, we can see it was up about 1.2, 1.3%. We can see here Kansas as well. Maine had a very good month. We can also see levels in New Hampshire and Pennsylvania and so on and so forth. So that's a month over month. It's not really that important on a month over month basis uh, what has changed, but more importantly on a year over year basis comparing this August to August of last year. These are the percentage changes of the average home price measured by Zillow. So some of the strongest states include Arkansas, Connecticut, Iowa, Kansas, Maine, Missouri, New Jersey, Oklahoma, Vermont, Wyoming. Some of the weakest states include Arizona, California, Colorado, Idaho, Nevada, Oregon, Utah, and Washington. Now, this in and of itself really doesn't tell us a lot because there's a healthy divergence between, small town, big city, different types of, industries within each state. But it's interesting to see the differences. And these, again, are measured by Zillow, which is a private company, not at all, you know, related to the numbers that are released, for example, by the US Census Bureau, which we're going to take a look at in just a moment. Now, this chart's very interesting. It goes back to 2004. It shows us the all states year over year average, the change. The average for all 50 states, we were to take the average home price on a year over year basis from 2004 to present date, we can see that, and the actual numbers are not as important, except for more importantly, we should say, is the patterns that emerge. So we see here 2006 or so, 2007, obviously we know what happened. We had a very big spike to the upside. Now, this graph actually shows us every state individually. The conglomerate all put together shows us the average. But we can see here now 2008, 2009, we actually bottomed out around 2010. This is when the majority of the states really showed us the worst performance that we saw. The housing market actually bottomed out. I believe the new home sales number actually hit its historic low in 2010. A little bit of a delayed reaction after the 2008 financial crisis, largely due to the housing market. Then we saw, home prices obviously return to the upside, hitting a very significant level around 2014. Then we saw a period of very low interest rates persist all the way up until, well, just a few years ago. Then we saw this massive ramp up of inflation. Notice this peak that we saw around 2019, 2020 actually surpassed on a year over year basis, surpassed the peaks that we saw 2007. That's how strong it was. Now, currently, we see from 2021 through present date, we see this chart now dipping to the downside. These orange, it looks kind of like fingers pointing to the downside. That's when we see on a year over year basis, these numbers turn to the negative territory. So we can see there's a number of states, not all of them, of course, but there's a number of states that are now dipping in the negative territory, territory that we would consider to be representative of early 2008, late 2007. Interesting to see how, this also the peak that developed. It's a much more broad-based peak that we saw as opposed to what we saw in 2007. Now, this is from the NAHB, National Association of Home Builders. Very curious. They mentioned in part that as of 2018, the state with the largest stock of second homes was Florida, about 1.1 million homes. That accounts for about 14.5% of all second homes. If we take a look at Half of the nation's second homes, we think of second homes, these are vacation homes. These are homes that we buy with disposable money. But when the economy goes bad, these are the first things we sell. So it's important to take a look at the nature of how the second home market is performing. It's considered to be a luxury good. Well, half of all the second homes within the entire country are found in 9 states. 9 states contain half of all the second homes. Florida, California, New York, Texas, Michigan, North Carolina, Arizona, Pennsylvania, and Wisconsin. Well, what we see here are the year over year changes for the second homes in the 9 states that we've mentioned. The black dotted line across the top over here, that's the average of all the homes. Now, we can see here the black line, that's the average for all the homes. Notice when we have very strong economies, 2005, 2006, this red line, for example, Arizona, while the average for the entire country was up year over year about 10%, Arizona real estate was up about 40%. That's when the economy is very strong. People have a lot of disposable money to buy these second homes. Florida's a white line, no surprise. A lot of second homes there. Then we see this orange, light orange line. That's California. So California, Florida, and Arizona. That's where a lot of second homes were purchased. But then we get into the bad times. 2008, 2009. What's the weakest line over here? Red line, Arizona. What they bought the most during the good times, they sold the most during the bad times, down 20, 25%. Arizona, California, Florida. Here we see Pennsylvania as well. Those are all below the national average. We then hit that very significant high in 2014. And once again, we see California leads the way, followed by Arizona. Going forward to 2021, 22, the red line here, Arizona, and then, of course, the white line, Florida. 25% year over year. Well, now, present day, the red line, that's Arizona. That's showing us a 10% negative return, 10% year over year decline, followed very closely behind by California. So it really is the same names that seem to repeat, the pattern over and over again. Point being is that when we see very strong markets, we tend to see Arizona, California, these 9 states perform very well. But when economies, run into trouble, we tend to see those homes go down by the most. Maybe the next time, the housing market takes a turn to the downside, it would be wise to look at some of these states like Florida, California, Arizona, maybe some of the others as well. Here we can see each line represents a different calendar year from 2002 through present day. And the x-axis at the bottom shows us the months of the year, January, February, March. So it shows us the progression, the year over year prices. So for example, the prices change. January, that's this January, or I should say January of that year compared to January of the prior year. So this orange line, for example, this shows us that's 2003. So when we see January, that's January '03 compared to January '02. Now, as 2003 progressed, we saw it peak in August. August 2003 compared to August 2002. So we saw 15, 16% year over year returns. Now, you may wonder, 2023, that's that black dotted line. We started out the beginning of 2023, January, 7% approximately year over year increase. Well, that started to decline to the downside, 5% in April, looked like 3%, prices only rose by 3% in June year over year, and that's basically where we are now. Well, how does that compare to prior times in history? What does a black line most closely resemble? Well, I would say the black line looks closest to the red dotted line. The red dotted line started out about 5% year over year gains. The black line around 7%. They seem to intersect around April, registering around 4% each. The black line a little bit below, but they're nearly identical patterns. Well, the red dotted line, that's 2007. Very interesting how the current year's housing market, measured by the average home prices on Zillow, most closely resembles the price action in homes we saw in 2007. There's another line that seems to be running in a very parallel manner, only lower. That's the white dotted line. Notice how the black line and the red line kind of go down at a very gradual slope. The white line seems to be following that slope almost almost perfectly to the downside. Well, that white dotted line, that's 2008. So notice the red line again, 2007 started 5% January year-over-year gains. The white line just a hair below 1%, about even. And as the the red line, 2007, by mid-year, red was at 3%, and by the end of the year, basically ended up flat. Well, that's where 2008 started. So the question is, if history's any judge, if 2023 looks like 2007, does 2024, do we end up at zero at the end of this year? Does 2024 follow 2008? Well, that's kind of a scary prediction. We don't know though, but it's very interesting to see the pattern is quite similar. Now, the red line is our US average home price, again measured by Zillow.com. The black line, now this is measured by the Census Bureau. So this is a government data collection service. This is a government agency. Zillow is obviously a private market, a private company. Well, the red line shows us the average home price year over year, and this is the average across the entire nation. The black line represents the monthly supply, specifically the ratio of houses for sale versus versus the number of houses sold. So when there's more houses for sale, like let's say there's a lot of houses for sale and nobody's buying right now, this black line's going to go up, like it did in 2007. Well, it wasn't so much that there was a lot of houses for sale at good prices, it's just that nobody wanted to buy. So this black line spike into the upside, that means that nobody's buying, or there's a lot less people buying than there are people putting their homes on the market. Conversely, when the black line goes down, it means that everybody's buying, and there's not a lot of that there's not a lot of homes for sale versus the amount of people buying. There's more buying than there are offers. So when the black line goes up, it's a buyer's market, lots of inventory. When the black line goes down, it's a seller's market, not a lot of inventory, maybe better prices. So we hit obviously that very significant high around 2008. That was a buyer's market. That's time to buy after the crash. Well, then we hit that very significant low. That's around 4, okay? The right side y-axis. So ratio is 4 houses for sale for every house sold, as opposed to 12 houses for sale versus for every house sold. Well, we kind of chugged along in a horizontal manner, around 5, oscillating between 4, 5, 6 in that area. Then we saw that temporary COVID crisis spike to the downside. Nobody was buying, but that really, I think that's kind of artificially skewed because, there was a lot of lockdowns. There really weren't a lot of homes being sold, being shown, so let's ignore that. But then we saw this huge spike to the upside. 10, 10 houses for sale versus every house sold. Well, that occurred, and that shows us that there was a lot of inventory out there. That was a good time to buy. But then inflation, interest rates starting to rise, it makes it a lot more difficult. And now we see a situation we don't have a lot of inventory. We're down to around 7 right now, 7.5 it looks like. That means there's only 7.5 homes for sale versus for every house sold. So, and we're hearing about this in the news over and over again. There's not a lot of inventory. There's not a lot of inventory right now. If you had to compare it, it looks like the same situation we had around 2018 when the housing market was very strong before COVID. Or we could say in 2006 before the financial crisis. And every time this line goes down a little bit more, it makes it a little bit more difficult for someone to buy. It makes a little bit more of a seller's market. Now compare that to the red line. Well, I'm sorry, the red line is the average home price. That's by Zillow. The red line is Zillow, the black line is the ratio we just spoke about. Now go back to 2008 with the financial crisis. A lot of houses for sale. the average home price goes down. Houses are very cheap over here. A lot of inventory. No surprise. We go to 2021. Home prices are very strong. And then we see a rise. All of a sudden, the inventory spikes up. As the inventory spikes up, well, more supply than demand, the ratio goes down. Now we see a situation where home prices, I don't want to say crashing, but they're going down pretty quickly. The average home price year over year was at 17%, and now we're almost zero, actually. The red line is almost at zero. On a year over year basis, it actually looks like there's almost no change, maybe a little bit above. So we have a situation now where home prices are going down and there's still not a lot of inventory. Interesting. The last time, and really, this cannot be understated, the last time the red line went down a lot, inventory went up. Why is inventory going down when the home prices are going down? It's because we're in this situation called a lock-in effect, where every seller out there says, if I sell my house, I know I'll make some money, I have profits, but then I have to buy a new house. And I'm going to lock myself into a new mortgage at 7% or wherever it is. No, no, no. I'm just going to stay put. So may that thing that's dissuading a lot of potential sellers out there. And that's why we have the very unusual situation when we see home prices go down, but inventory is also going down. Here's the red line, U.S. average home price measured by Zillow. And the black line is the new one-family houses sold. These are the actual homes sold. And this is, again, a number. I believe it's multiplied by thousands. This is a very predictable, normal correlation. When the average home price goes up, reflected by the red line in 2006, new one-family houses that are sold goes up. After all, most of the market kind of follows a trend. So when the price is going up, we say we're going to buy, we're going to buy. Everybody wants to buy. Then houses go down, and then everybody wants to sell together. And then houses go up. Notice the home prices spiked a lot higher than the new one-family homes. This is a result of very low interest rates. 2012, 2013, we had zero interest rates. Well, then we had somewhat of a return to normalcy. Now, average home prices, even though no new one-family homes sold, this line started to decline, prices continue to go up. This is our inflation. Well, then inflation was met by the Federal Reserve, and the Federal Reserve really crushed this home price index. We went to the downside. And now we see, interesting again, new one-family homes are sold. That line is going up, even though the price is going down. Is that counterintuitive? Well, not really, because most buyers out there are trend followers. So when the prices go up like they did in 2004, 5, and 6, the number of new one-family homes sold also goes up. If prices are going down, it's usually the result. I mean, think about the mechanics of the market. When prices go down, it means there's more sellers than buyers. If there's more sellers than buyers, like the stock or anything else, the price goes down. So why are new one-family houses sold going up right over here? That's the contradiction. And that is a result, again, of the lock-in effect. Red line here, same line. Zillow, average U.S. home price. Black line, new one-family homes for sale. These are the homes on the market. Supply. Supply went up a lot. In 2006, home builders are responding to demand. Average home price goes up. Hey, those home builders say, we can make some money. Let's build some homes. Well, the home prices went down, and the home builders, for whatever reason, it's the nature of the market, they kind of overshot. They should have stopped building homes. Or maybe it wasn't so much a home builders, maybe it's just the nature of the market, the mechanics of the market, that the inventory goes up when the prices go down. Now we don't want to buy. We say, oh, prices are going down. That's why there's more inventory. Well, then there seems to be a little bit of a delayed effect. Prices hit the bottom around 2008, 2009. The new one family homes for sale, the inventory didn't hit a low until 2012. That's actually kind of interesting. There seems to be a delayed effect. So if we see the housing market collapse, Maybe the lesson, the takeaway from this, don't rush in too fast. The housing market, the inventory seems to be delayed behind the actual prices. Then we see the prices peak around 2021, and take a look at the inventory. The inventory didn't peak around till July 22. Another little delayed effect. Now home prices are crashing. Oh, I don't know, crashing, but they're going down a lot. We went from 15% year over year now to almost zero. New one family homes for sale. Well, this looks like it's starting to peak to the perk its head to the upside again. The inventory was going down, but it looks like inventory is starting to rise. Maybe inventory is starting to rise because the trend is your friend, and a lot more people are saying, "Hey, I think the housing market doesn't look so good anymore." Now, this is a very interesting chart. The red line is a Zillow US average home price, same as we were looking at before. The black line represents the 10-year US Treasury minus the federal funds. It's a 2-for-1. Take the 10-year US Treasury currently, let's say 4.5%. The federal funds rate right now is 5.5. So we have a negative one, around 1.5. Well, that's where we are now. Now, the reason why we consider this, let's start from the left-hand side of the chart. 2003, 4, 5, economy looks good. Stocks are going up. The home prices are going up. Everything's great. That's inflation right here. What happens under a period of inflation? The treasury yields go up. Treasury yields are always competing with stocks. When stocks go up, the 10-year bond says, I can't find any buyers at 4%. I'm going to offer 4.5. I'm going to offer 5%. Well, eventually, this inflation really peaked out. We had a 2025, oh, I'm sorry, a three, that's a right-hand axis, a 3.5 spread. The 10-year treasury was paying about 3.5% more than federal funds. Where were federal funds at 2005? Probably, if memory serves correct, only a couple percentage points. Well, a couple percentage points plus 3.5, that gives us 5.5% 10-year US Treasury yield. Well, what happened then? The Federal Reserve says, "Oh, wait, inflation's kind of getting out of control. Let's raise interest rates." Well, this black line is a 10-year Treasury minus federal funds. So when interest rates go up, this line goes down. It's the 10-year minus federal funds. This line going down reflects rising interest rates. Rising interest rates send this line down to a -1. That's when federal funds was actually higher than the 10-year US Treasury bond. 2007, 8, stock market crashed. What does the Federal Reserve do? They cut interest rates. They cut interest rates. The federal funds rate falls back below the 10-year US Treasury, and this line goes up. The 10-year US Treasury is moving as well. But when this line goes down most drastically, it's the result of the Fed raising rates. Now the Fed cuts rates, the 10-year bond goes up, and then the market says, hey, interest rates are very low. Maybe it's a good time to invest. And the bond market, like any other market, it's a forward-looking mechanism. It's made up of all of us trying to guess the next step. So yields go up in anticipation of better economics. And they're following the stocks, which are going up as a result of better economics. So this line's going up first because the Fed cut rates, but then because of those low rates, it led to a rising yield in the treasury. So we see home prices go down, and this line goes down. The line goes down ahead. It really is amazing because it's somewhat of a leading indicator. The home prices crashed as a result of the Federal Reserve raising interest rates in parts. Well, this line already had moved. The black line moved ahead of the red line. Now we see the black line goes up and then the red line goes up. The black line goes up because of low federal funds. Low federal funds, which then led to high treasury yields, which in turn eventually led to a strong housing markets. Then we see 5% year over year returns on the average home price measured by Zillow. Then we came back and forth or treading water for a while. And then we see this black line go down again. Black line goes down. Well, that's either result of the 10-year bond going down or the Fed funds rate going up. Well, the black line, I'm sorry, the Treasury bond did not go down in 2019. This was the Federal Reserve raising interest rates prior to COVID. All of a sudden, we had that COVID stock market crash. Fed says, uh oh, cut rates. Cut rates, this black line goes up. Now we see, fast forward to present day, we peaked out on the Zillow average home price around 17% year over year returns around August of 21. And this black line started to move down. The black line moving down. What did the Federal Reserve do? Increase interest rates at an historic rates. So interest rates go up more than the 10-year U.S. Treasury, and this black line goes down as a result of the Fed raising rates. And then, if history is any judge, when this line goes down, when the black line goes down, as it did here, what happened afterwards? Maybe about 6 months, a year later, the average Zillow price went down. Well, is history going to be a guide in the future? Well, Zillow price is already registering basically a 0% return. When does this all change? Why is all of this useful? Because if we anticipate, for example, first of all, the housing market, if we're a bear, we say, yeah, the housing market's going to be awful. Let's get out of the housing market. Well, we would expect the Fed to cut rates. The Fed's going to cut rates. Now, I know they're raising rates right now, but the Fed's going to, it's called a pivot. They're going to pivot and they're going to start cutting rates very, very quickly if the economy really looks like it's falling apart, especially in terms of the housing markets. Well, if the Fed cuts rates, this black line goes up. We want to watch very closely the 10-year Treasury minus Fed funds. And it's very easy. You can calculate it on our own. Take a look at where the 10-year Treasury yield is trading at right now. Around 4.5. And we subtract from that Fed funds, which is 5.5. If we start to see that number go up, then I think it's anticipation. The Fed sees maybe the housing market's going down. Conversely, if this black line continues to go down, it means the Federal Reserve is still raising rates, which we know is, at least a current trend. So it's an extremely, extremely interesting indicator, the 10-year Treasury minus Fed funds, and it looks like it could be actually somewhat helpful in leading what we would expect to happen in terms of the housing market. And again, measured by Zillow.com. It's a private company. It's not related at all to the Census Bureau. So I think it's a pretty fair measure of the housing market overall. We're going to continue to watch these numbers, of course, and we'll update you along the way with any significant change as well. We hope this has been helpful. We look forward to seeing you back soon.